share my screen. Okay. Right. Now let's look at the which is the video 3 on deferred taxation. And let's first look at the definitions of these two. As I clearly explained, you just need to understand the difference between a current tax and then the deferred tax. Current tax is where will be computed based on the taxable profit that the company or the person has made for that particular period, right? Current tax is the tax that is related to the taxable profit, tax that got charged, computed based on the taxable profit for that period that this particular person has earned, right? So basically, if the accounting profit is given, we would convert the accounting profit in the taxable profit for that period, and then the tax rate would be applied. That is current tax. And as I said in the previous video we looked, when the current tax, when the current tax are not paid for the current period or the previous period current tax are not paid, then that will be moved into a tax liability, right? That is what current tax means. It is the amount actually payable to the tax authorities in relation to the trading activity. So we would convert the accounting profit into a taxable profit, and then the tax rate will be applied. That is what its current tax means. A deferred tax is not an amount payable to tax authority. It's an accounting measure. Basically, what we're trying to do, if we find there is a mismatch between the accounting measure and then the tax effect, right? The effect of the tax effect of the transaction. When there is a mismatch, that's where the deferred tax will be used to remove that mismatch, right? So, but and in the last video also we noticed a tax charge that goes to the profit and loss account for that particular period would include both current tax and deferred tax, right? So having said that, so whenever you read the deferred tax, it says it is an accounting measure used to match the tax effect of the transactions with their accounting effect. That means the accounting effect and the tax effect need to be matched, right? To achieve that matching is what the deferred tax is used. I'll explain this through this the data which I've used earlier to explain the deferred tax computations, right? So this is what we looked at it earlier. This is what we looked at earlier. This is the first one. And we said to explain how the deferred tax is computed, right? So we said the accounting books, the non-current assets, accounting books, we would register them using, this was used a straight line basis depreciation, and we found the carrying value, right? So straight line, these are accumulated depreciation. Therefore, these are the cost figures every year. Carrying value was this one. And then it will wipe, everything would be taken off at the end of 5 years because it's a 5-year useful life of the asset, right? And then later also we said the tax authorities compute them. This is how the tax authorities would work, right? This is how the tax authorities would work. Right? This is how the tax authorities would work. But what they would do in their books, this would be their tax base. This would be their tax base, right? The tax written down value. This is what they have in their books. Basically, from the cost, they deduct the complete allowances, and this would be the tax deductible value. So this would be the tax base book. In my books, I have 800 pounds for the non-current assets, but for the same period, tax authorities book shows 0, right? So there is a temporary difference, right? There is a temporary difference between the figures of mine and then the tax authorities in year 1. And that would be the difference between carrying value and then the tax authorities tax base value. Difference between the carrying value and the tax authorities tax base is what is known as temporary differences. There are two types of temporary differences. One is taxable temporary difference. That means if I'm going to suffer tax in the future, right? So that is a taxable temporary differences, which would initiate a deferred tax liability. For example, here in my books, I'm claiming 800 pounds worth of net asset. That means in future, I'm going to use this in business, going to make profits. So those profits would be subject to future tax, right? But tax authorities books, there is no value for this asset, right? So when they computed the tax liabilities, and there is nothing there, so the tax liabilities did not include these 800. So I'm declaring 800 higher value than I supposed to be, right? So this 800 would suffer future tax liability. So it is a taxable temporary difference, and then on this we would apply the um, tax rate, right? Which would give us the deferred tax liability. So what happens at this point, right? What happens at this point? Let me move a bit further. What happens at this point? When we come, this is how you compute, right? We have carrying amount. We have the carrying amount. The carrying amount. We have the carrying amount. The carrying amount in this case, accounting book value was 800, but then I have the tax base, which is in the tax authorities books, the tax base. How do I call this? Tax written down value, right? In their books, it was 0. So I have, in my books, I'm declaring 800 more than I'm supposed to be in terms of asset, right? So I will be using this to make profits. So there is a temporary difference. So I'm going to make future profits, and I have to suffer tax as a result of this. So this is known as taxable temporary difference. Is taxable temporary difference, right? So I have a taxable temporary difference here. On this taxable temporary difference is what the tax rate would be applied. Tax rate would be applied. So tax rate is 20%, right? So I would have a deferred tax liability, right? A positive figure would give me a deferred tax liability. So I would have a deferred tax liability. Explaining. So what would be the deferred tax liability I would encounter here? 800 times 20%, right? So that would give me 160. So actually, this is not the full amount that would go to the profit and loss account, right? So what happened here, when we compute deferred tax liability, when we're going to compute this deferred tax liability, but when you're going to compute this deferred tax liability, should I see? When you're going to compute this deferred tax liability, right, on this, right, what happened here, this deferred tax liability is actually the carried forward balance, right? The carried forward balance, in the deferred tax account, if I'm going to have a deferred tax account, in the deferred tax account, the carried forward balance is what this 160, right? So because it is the first year that we have started, there is no brought forward balance. There is no opening balance was 0, right? And we know the carried forward is 160, opening balance is 0. Therefore, the difference between the opening and then the closing balance is 160. This 160 is what would go as a deferred tax expense to the profit and loss account. Deferred tax expense, the profit and loss account. This is how the deferred tax would work, right? So basically, because in the first year, exactly the same amount would appear as a charge to the tax, to the profit and loss account. But actually what happens, the figure that we're going to compute based on the differences is the closing figure, right? It is the closing figure, right? I would continue, that you would be able to understand. Now see, we have calculated the deferred tax liability, which is 60. So the profit and loss account figure would be the movement figure, right? This is the liability figure, 160. So the movement means difference between the closing and then the opening balance is the movement that goes to the profit and loss account. This would go to the profit or loss, right? This would go to the profit or loss. So that's done, right? The movement is what will go to the profit or loss. That's done. And also we have already say current tax we computed based on the taxable profit. Early examples we computed this 40 based on the taxable profit, and now we should be able to find, so this figure, deferred tax and then the current tax, it's my tax charge that go to the profit and loss account. That's done. So what has happened, for if I move on to my second year, right? When I move on to my second year, year two, in the year two, actually my deferred tax, if this was year two and this was year one, right? And actually in year two, I would have a brought forward balance. What was my brought forward balance? The carry forward of last year would appear as a brought forward balance. Now I would have my closing balance, deferred tax, that would be the due to the temporary difference of the second year. So what is a temporary difference of second year? Now if I can do this from here, right? So in my books, I have 600. That is my carrying back. In the tax authorities book, their tax base is zero. Tax written down value was zero because there is no allowance was given, right? That was everything was given the first year. So there is no difference, right? So they would have a zero figure for the tax base. Actually, if you're gonna, this figure is the cost and this figure is the accumulated tax depreciation. So the accumulated tax depreciation capital allowance means opening balance was 1,000. There was zero for the next year, so 1,000. So it was zero. So 600 minus zero, it is a temporary difference of 600, right? So I would have a temporary difference of 600. And on that, I would charge 20%. So that would be 120. So my closing balance here would be 120, right? So what is the movement now? Deferred tax movement, right? So deferred tax movement for the year. So what has actually happened in this case, right? In this case, what has actually happened, it is dropped. So I would have a negative 40 here, right? This negative 40 will be taken to profit and loss account. That means it is not a charge. It is credit side to the profit and loss account, debit the deferred tax liability, because deferred tax is a liability. If the liability got reduced, so credit profit and loss account, debit deferred tax liability. That's why a negative of 40. Likewise, the remainder works. So what I'm trying to explain here, it is the final impact. See, earlier, when we tried to without deferred tax liability, you could see the tax charge was not even. We made the same profit, 1,000, but the first year's tax was 40, and then 240. So it doesn't make, there is a mismatch, isn't it? Why? For the 1,000 profit, the profit I made earlier for 1,000, right? The accounting measure which I made for 1,000, the tax effect and then the accounting effects did not match, right? The tax effect and then the accounting effect did not match. Why? Because the full amount was given in the first year allowances. So in my first year, the tax effect was different and it did not match to the accounting effect, right? So once I've introduced the deferred tax, see, once I introduced my deferred tax movements for the year, and you could see what happened thereafter, my tax expenses, right? Now it matches, isn't it? So now my profit for every year, I have 1,000 profit and the tax is also the same every year. So that means that mismatch has been removed when I introduce the deferred tax. So that's the idea behind the deferred tax. Now let's quickly go through the remainder. So as I pointed out, deferred tax is simply an accounting measure just to remove the mismatch between the accounting effect and then the tax effect of the transaction. So the deferred tax is an accounting measure used to match the tax effect of the transactions and then the accounting, right? So basically what they're trying to say is this. Say we have a future tax consequence of a transaction, right? So we have declared, we say, for example, I'll take this example here, right? For this, on my books, I have declared 800 worth of asset, right? And I did not put any deferred tax. So what's going to happen? I know in future I'm going to make some profits, but those profits would be subject to tax, right? Those profits would face tax liabilities. But if I don't recognize that tax liability now, what would happen? My shareholders would think I'm making too much of profit, so they would ask me to pay more dividend, and I would pay more dividend. My earning per shares would be higher. The information that I'm presenting would not something that is correct, right? So it is important that any future tax liabilities need to be taken into account, right? That's what it says. And then we have these things, I've just covered. A temporary difference means carrying value minus the tax base. That is a temporary difference. It can be taxable temporary difference. That means it will create a deferred tax liability. So the double entry would be a credit deferred tax liability. Debit has to be the profit and loss account, but the movements only. When we apply, that would give us the closing balance. Then we need to compare with the opening balance. Deferred tax asset means the different temporary difference is a deductible temporary difference. It's going to give me some future tax deduction. So it is a deferred tax asset, therefore debit asset. Debit deferred tax asset, credit the uh, uh, profit and loss account. And here the movement is what is credited, like we credited 40 there, right? So let's look at this paragraph here. So in this paragraph, it clearly explains why that we suffer deferred tax, right? And for example, an asset that we may have recognized the value in the books, but the tax authorities may have not attributed any value. So that would create a deferred tax liability. Likewise, the other reasons, for example, certain expenditures, and we would follow, accountants would follow IFRS, tax authorities would follow their rules. So it would create some temporary differences that need to be recognized. And then the just to link the conceptual framework as against the deferred tax. In conceptual framework, an asset and liability means due to a past event, we have a present obligation. That is the definition of a liability. So due to a past event that matches with the deferred tax liability, due to a past event, we're gonna suffer a future present obligation for a future liability. That matches the deferred tax liability and also deferred tax asset. That means we have a right to receive future cash flows that matches the deferred tax assets definitions, right? And also the match accrual concept. Accrual concept is where, according to conceptual framework, right, expenses for that particular period need to be matched against the revenue made for that particular period, right? So that again matches with the deferred tax. We are trying to remove that mismatch between the accounting and then the tax measures. And then, as I pointed out, we know how to calculate the deferred tax. Tax base is the figure, the amount attributed by the tax authorities. In our example, for the fixed assets, we said tax written down value. It was a tax base, right? And I think I've done this. It's not that difficult. So let me also move on to the next line on tax rules. Let me quickly explain these tax rules one by one, right? So as I, we would, because these are the different kind of examples you can face. So if you take a property, plant, and equipment, how we record on our books as an accountant, we will record them carrying value, right? Carrying, how to get that carrying value? Cost minus accumulated depreciation, that is the carrying value. That's in on our books. But tax authorities would not give accounting depreciation, they would tax depreciation. So they would, how they would work, they would take from the cost, they would take off the accumulated tax depreciation, and that would and then that would give us the sorry and that would give us the tax written down value, right? So that's the difference. There will be a temporary difference available, but this difference would be removed once the difference will be automatically removed once it fully, like accounting depreciation, tax depreciation reach the full amount, and it will be removed. That's why we call it temporary difference. That's for the first. And then the second item that we could think of, which is the accrued income, right? So accrued income is where we haven't received the income, but then because when you apply IFRS, we need to add that income to the current period. So on our books, that's how we would record. But when you consider the tax rules, there are two possible ways of that. Generally, the tax authorities, they would record them only if they received cash. And right, so here accrued means we haven't received it. So tax authorities would consider them only if they receive cash. So on my books, I would have an so I haven't received this amount, right? So what would be my double entry? If I haven't, so I'm expecting to receive. So it is an asset to me. So I would have an asset on my books. Carrying value would be there, right? Receivable. Carrying value would be there. But on tax authorities, that amount would be zero because there is no amount receivable. They will recognize only if the cash is received. So on my books, I would have an asset value, but for that carrying value, tax authorities figure would be zero. So there is a temporary difference that would arise, and it would be a taxable temporary difference, right? On the other hand, sometimes tax authorities can also follow accrual basis. If they're also following accrual basis, then there is no difference between the way that I treated in the accounting books and then the tax authorities books. There will be no difference. There will be no temporary difference in that case. So the next example is where accrued expenses. Accrued expenses is the opposite of this. This is where that even though we haven't spent the cash yet, right, we would have to treat them in our books now, right? Why? Because that's what the accrual expenses means, right? And so in that case, I would have, even though I haven't spent the cash, right, I have an accrued expenses, right? So this would be shown as a liability on my books, on my liability, included in the financial statement as see. It will be included in the financial statement. I think I missed this as a liability. I think this is these two together, or these two together. So if you have an accrual expenses and provisions, right? Accrual expenses and provision, it is included in the statement on an accrual basis. That means payable, right? So even though I haven't paid cash, I have to show them as a liability. So on my books, there will be a liability. But tax authorities, again, they have two approaches. If their approach is cash, they would not have any figures. They would have no liability on their books, right? So for my liability, their figure is zero. So there is a temporary difference. And that temporary difference, I would suffer. I would, that temporary difference here, and that would create a temporary difference and deferred tax, right? And so on the other hand, again here, so basically this kind of, when you have an accrued expenses, right? So I have already deducted in my books. I have deducted in my books, right? That expense, but tax authorities have not deducted it in their books. They would not have no value, right? So they right. So this would generate a deferred tax asset, right? That's what it would generate, right? Once we do an example, then you would understand this even more, right? And but if we both are following payables, then there will be no difference that we would have, right? Okay, let's move on. Right, the next one is where the income received in advance. So when I receive income in advance, I can't record it as an income in my books. It is a liability because I received it for the next year's income. I have received it now. It is not an income for me, right? So because I follow accrued concepts, so next year's income I can record it in my current period. So I would have received this cash debit. Credit would be deferred income, which is a liability, right? Deferred income, which is a liability I would have. But for that liability, deferred income liability, on the tax authorities books, there is no liability in terms of tax authorities, right? And they would have recorded it when they receive cash, but therefore there is, for the tax liability, there won't be anything there, right? And so that would create a deferred tax, right? So these are the examples in different ways in which deferred tax could be generated. And here, I think we looked at these examples. And the first example is the plant property equipment, and then how the tax base work, and then the measurement, right? Deferred tax as measured at the tax rate. I think we have also covered this, and I have also covered this. How do you calculate deferred tax? The carrying value minus the deferred tax. Sorry, carrying value minus the tax base. It is a deferred temporary difference. From the temporary difference, multiply by the tax rate, you get the deferred tax carried forward balance, right? In the movement from the opening, you would get it. It can be two types. You can get a deferred tax liability or deferred tax asset. Taxable temporary difference would give us a deferred tax liability. Deductible would give us a deferred tax asset. Right. Now let's look at this example quickly, and then I would allow you to go through the text next one. Right. So let's quickly look at this example here. So here what they have said, the company has purchased an asset which is 1,500, and then carrying amount was 1,000. So if you take the accounting books, right? If I take the accounting books, in my accounting books, I would have cost, which is 1,500 minus they did not give the depreciation, but then they have given me the carrying value. So that means cost minus accumulated depreciation, I would have reached the carrying amount. That's my accounting books I would have. But on the tax authorities books, they would, from the cost, they would deduct the capital allowance, the tax depreciation, which was 900. And this is the tax written down value, which is the tax base, which is the tax base. That means for the same carrying amount, tax authorities would, in their books, they are giving us only 600 pounds worth because of the difference in the depreciations, right? The difference in the way in the depreciation. That means the capital allowances have many rules. Some capital allowances can be annual investment allowance. We can claim everything at the upfront 100%, right? So likewise, they have given more allowances at the start of the year. So the temporary difference for me here, carrying value which was 600, carrying value which was 1,000 minus the tax base which is 600, temporary difference, right? So here the temporary difference, the temporary difference is 400. This temporary difference, I should have had only 600 on my books, but I have declared 1,000. I'm declaring 400 more. So due to this more asset I'm declaring, I would be paying tax in the future. I would suffer. So this temporary difference is a taxable temporary difference. As a result, I would suffer deferred tax liability. So the deferred tax liability is 100. So the way it would work, my brought forward deferred tax, that if this was the deferred tax account, if this was a deferred tax account, I have a brought forward figure, which is if I have a brought forward figure which is 0, and then I have a carried forward figure. Right, the carried forward figure which I have a 100, right, which I have 100. And the difference between these two is the deferred tax movement, right? This deferred tax movement that will go to the profit and loss account as an expense in this example, right? That is 100. This deferred tax movements that going to go to profit and loss account is 100. This will go to the 100 as the charge, right? P&L. It goes to the profit and loss account. The double entry for this, debit P&L, debit profit or loss as deferred tax expense 100, credit deferred tax liability, credit deferred tax liability. And that is the double entry for this. I hope that's clear, right? So, and then we have some few examples here for you to go through on deferred tax, right? To asking us to find out whether the deferred tax or not. We have a machine 10,000, carrying amount of 8,000. So carrying amount is what I needed from book value. I have 8,000 as a carrying value, but tax authorities depreciation was 3,000. So cost minus tax depreciation. Cost is 10,000 minus tax depreciation. tax written down value is 7,000. That means tax base is 7,000. On my book, carrying amount is 8,000. Tax base is 7,000. So 1,000 temporary difference. I'm declaring more assets. So it is a uh, taxable temporary difference of 1,000. So I would have to apply the tax rate on that temporary difference. I would get a deferred tax liability. That's the closing balance. Opening balance is 0. So the movement is also same as the amount, right? They said they're asking us to only compute the deferred tax temporary difference. Interest receivable has a carrying amount of 1,000. The related interest revenue will be taxed on a cash basis. So tax authorities on my books, I would have a interest receivable. That means I'm expecting amount. So on my balance sheet, I would have an asset carrying value for 1,000. Tax authorities would not have that asset in them. They would only receive cash, only they would have this. So there is no carrying value in their books for this asset that I have declared. So their tax base is 0, nil. 1,000, temporary difference is 1,000. So I would have a temporary difference of 1,000, right? And so then again, temporary difference, taxable temporary difference. Next one, trade receivables have a carrying amount of 10,000. And related revenue has already been included in the taxable profit. So what they trying to say here, right? Say tax base of the trade receivables is also 10,000, right? And so basically what they're saying here, trade receivables have a carrying amount of 10,000, and then related revenue has already been included in the tax authority. That means tax authorities also have taken this amount in their books. So carrying value and the tax base would going to be the same. So there is no temporary differences in this case. So the loan receivable has a carrying amount of 1 million. In my books I have, but the loan would have no tax consequences, right? So again, because the loan is not taxable, and so the tax base is deemed to be the carrying amount of the loan, right? So there is no impact on the tax liability, right? Because uh, it has no tax consequences, right? It has no, because if it has no tax consequences, my carrying amount and the tax authorities figures would be the same, right? And that's done on this part. And then I would do the illustration. I'm not going to work out this illustration because this is simple illustrations, how to explain. I think I've done this through that. So you can go through them, and then I would work out this example. And I can also do this as well because we have gone through this. Uh, how to calculate the difference between how to calculate the deferred tax liability, and also the temporary differences, deferred tax liability. Same slides again and again. And it says revision from financial reporting, and we have just looked at one particular item, plant and property. I've covered this, right? And so moving on to the next slide, we have done this as well. First one is plant and property equipment. What is the difference and why it is a temporary difference between plant and property equipment? And then the next item was accrued income or accrued expenses. I also have we covered this, right? Why it is accrued income, accrued expenses. And then we have this illustration too. I'll cover this illustration in the next video, right? Thank you.